So, hi, welcome, James and Lorraine, and thanks for giving up some of your time to have a chat today. I'd like to get into a topic which I think is going to impact a large part of the financial services organisation or organisations in fintech and finance in the UK, but also a topic that I think many people don't know about, don't care about when they probably should. And if they've heard something, just probably find the whole thing quite inaccessible. So I thought we'd have a chat today and just make this really important topic a bit more digestible, give a bit of context where it comes from, and hopefully that chat's useful for other people. Of course, as the title of the podcast says, we're going to be talking about the exciting topic of FCA's safeguarding rules and the changes that means. Uh, if we put that more simply, at least in my language, is the business in the UK is changing and the regulatory framework's changing, and everybody in the space really needs to understand that. So, should we just kick off with little intros? A bit about yourselves, your background, each of you, where you come from, um, and what your role is, what your job is, and what you care about. Should we start with you, Lorraine, if that's okay?
Absolutely. Thank you very much, Adam, and thank you for the invite today. So my name is Lorraine Moton. I'm a partner at Thistle Initiatives. Thistle Initiatives is a regulatory risk and compliance firm looking after various areas of FCA regulation, but I am predominantly in charge of the business's payment services function, so taking care of the risk and compliance for all payment services and e-money type firms. Um, where I come from geographically, I mean, I'm originally from Scotland. The accent's going to give that one away, but I work and live in London now and have done for many, many years a year. What matters to me particularly, I think, what I'm really passionate about, if I'm honest with you, is the fact that regulation isn't seen to be squishing innovation and competition, and we know the government's looking at that, and I don't know whether that's just a bit of rhetoric and how that will actually play out in real terms, but I'm very passionate about not overdoing regulatory burden for firms and making sure there's a nice balance so that we can see a lot of innovation, a lot of new players to the market. Economically, it's going to work for us as a country. So I'm very passionate about having that balance between regulation and firms being able to do business.
Cool. I'll definitely dig into some of that as we go through the conversation. And James, do you want to do the same?
Yes, so hi, and thanks for having me along for this. So I'm a partner in the CMS Financial Services team. I bill myself as a consumer finance and payments lawyer. I've been doing that for the past 10 years or so, focusing on really sort of fintechs and innovative consumer products and how those are building into the payments and e-money market, which is where I came across safeguarding in the first place. My sort of real passion in this area is helping businesses be successful whilst also bringing success for their customers, and safeguarding forms a real part of that. The idea of being able to work within the regulatory environment for the benefit of both the firm and the customer is something sort of I really focus on in the areas of work I do, and trying to help firms navigate the rules to achieve that outcome is a real sort of real passion area for me as well. Much like Lorraine, I'm originally from Scotland as well, but moved down at a relatively young age to the glamorous location of Reading, so very used to the English life now.
Good stuff. And thanks again to both of you for having this chat with me. It's the first time we've done one of these together. So yeah, looking forward to the chat. So safeguarding. I mean, already, what on earth is safeguarding? I mean, before we talk about the rules and why it's changing, there might be people that are watching this that are in the UK and they hear about concepts like safeguarding client money and customer money and probably use these things interchangeably. And there might be people from other markets like the US, for example, that have like no reference to what this means. And there's more and more firms coming to the UK from other jurisdictions. Do you mind just giving a little bit of context of what is this concept of safeguarding and what it's all about before we dig into the meat of the topic with the rules and what's changing? Either of you want to take that?
I don't mind jumping in. So safeguarding, it really refers to that practice of protecting client funds which are held by a third-party firm. So the purpose of safeguarding is just to make sure that those funds are kept safe and separate from the firm's own funds. Now, in the context of financial services, and particularly in payment services and the e-money world, they're really in place to make sure that the client's money, so the person who belongs to the actual money, is not at risk, particularly if the firm faces some financial difficulties or, God forbid, insolvency. So it really requires funds to segregate those funds from their own operational funds. And that means, therefore, if the firm does go bankrupt, the funds can still be returned to whomever they belong to and not mixed up with the firm's own money and then get lost in that insolvency situation. It's typically achieved by holding client funds in segregated accounts, or third-party custodians, like a bank, to manage those funds. Some firms also use a mixture of segregation and an insurance model. See less of the insurance model, if I'm honest. And really, the whole purpose, like I say, is to offer protection from the firm's creditors. So if a firm gets into financial difficulties, the creditors of the firm should not be able to claim those funds. So therefore, by separating the funds, the money's protected from any claims, made by the creditors. And also, I think what it does is it requires firms to therefore maintain very accurate records, transparency and accountability about where those funds are and how they are managed, which includes lots of sort of like reconciliations on a regular basis, and reporting to the regulators and to auditors in terms of safeguarding compliance. And the main sort of point here, just to stress, is the fact that if the firm goes into bankruptcy or enters insolvency, then the safeguarding will ensure the funds can be returned to where they belong.
So I was just going to say, so all sensible measures that anyone should care about, whether you're the customer, whether you're a service provider, whether you're a regulator, or whether you're the bank of the service provider, everyone should have this sort of safety in mind and protecting customers. James, you were going to say?
Yeah, I was just going to sort of emphasize the point that Lorraine was making, that it is a real sort of key customer protection, because something that customers often misunderstand or don't appreciate is things like FSCS, the deposit guarantee protection, doesn't normally apply to payment services firms and e-money firms, and therefore they don't have this safety net of that compensation scheme. So they need this safeguarding regime in place to ensure that if the worst does happen, there is money there to return to them.
Yeah, and I guess that's pretty difficult to achieve. And when I say that's difficult, I mean having customers understand some of these really complex topics. So that must be a challenge in itself. And I guess the fact that we're talking about material changes here to rules, to a scheme that's existed for quite a number of years, there must be a few things that have kind of gone wrong along the way, or learnings that have happened. Should we reflect on what some of those learnings have been for the industry, and what's driving the rule changes? Should we dig into that?
Yeah, I mean, happy to sort of speak to that a bit. I mean, I think the reality is, in the past couple of years, we've had a few payment services and e-money firms go insolvent, and it's been found that there have been shortfalls within the safeguarding proceeds, meaning customers are potentially losing out. They're not having their full balances returned. The big case in this area, the IPIGU case, as it's called, was all about, can we trace effectively funds into other assets, or chase down where money that should have been safeguarded actually is, to avoid this shortfall for customers. And it's really driven the FCA's thinking about this and sort of building in these additional protections to ensure that sort of customer harm is mitigated as much as possible. There's also been learnings of the fact that this regime was ultimately derived originally from European legislation. It doesn't reflect, or it isn't quite the same as the UK's own sort of CAS investment regime. And the FCA, I think, struggled with that in the past and is now trying to align them a bit more, get firms used to operating under both regimes at the same time.
So has CAS been around a much longer for much longer then, and much more established as a sort of framework, and then this safeguarding framework came in much later?
Yeah, I think that's an entirely fair sort of point to make, that CAS has been developed sort of for a larger industry that's sort of covered the investment firm world and the insurance world to an extent for a much longer period of time. There's been a lot more, I guess, jurisprudence history to learn from in respect of it and how firms operate in that regime, which has allowed the FCA to develop the rules over time. Whereas it was the original PSD rules that came in that set this safeguarding requirement. They were designed for the entirety of Europe, not just the UK, and therefore different European legal regimes. So it was a very different regime to what the UK was used to. And now they're looking to, well, in the UK, following Brexit, sort of trying to line them a bit more because they've got that flexibility to do so.
Yeah, and Lorraine, your firm works with a lot of organisations to help them either get established with their licenses, I believe,
Yes.
and give them guidance along the way with the licenses and the obligations that they have. Can you
Yeah.
give us a sense about how big the market is for these kind of changes? Is this affecting a couple of dozen firms in the UK, or are we
Oh
talking
no.
hundreds or thousands?
Oh,
I mean,
thousands.
in my
I would
view,
anticipate. Yeah, I mean
yeah,
it's relevant to any firm who's currently following this the safeguarding rules as they stand at the moment. So that is quite impactful. And I think also, I mean, the CAS rules as they stand for like investment firms. I mean, we're dealing with firms. In terms of the regulatory journey, those tend to be businesses that have been used to being regulated for a much longer period of time, probably much more well established, probably very different in terms of size and shape and scope of firm. And a lot, not all, but many of the payment services firms, particularly the ones we deal with, are more smaller in nature, small to medium size. So they don't have the big budgets, you know, they don't have the big all singing, all dancing compliance sort of teams that are there to help them navigate some of this. They don't have, you know, they don't have the budget to start looking at some of these changes, and it will require quite significant change. So, you know, I think this is definitely going to be, it's one of the biggest, I think, of late, biggest impactful from a probably a financial perspective for smaller firms than some of the others, given the nature of the way in which they are, well, they're going to have to take extra steps. I think from a process perspective, they're going to have to look at the third party banking partners and the way that their accounts are structured. And, you know, they're going to have to pay for a statutory audit, which is very different to the type of audits that we've been providing. We're not statutory auditors, although we've got a solution for that, which is another story. But that's all cost to the business. One thing I want to say just about, you know, just why we're here. I think the fact that the firms were getting it wrong. Okay, they were doing it all wrong, and the FCA were very uncomfortable and nervous about that. But actually, behind that, I think firms need to think about what drove that. And for me, in my humble opinion, it was lack of proper oversight, lack of governance, and inadequate kind of transparency and reporting, and also weaknesses in those sort of third party relationships or relationships they have with their banks or custodians. So, you know, I think it's fair that it needs to be looked at for those reasons, but I'm not quite sure that the regime that's being proposed is going to be appropriate for the
yeah.
payment services world.
I did have an attempt at reading a consultation paper that came out at the end of last year. It was 260 pages, and I honestly didn't have the time to digest it all. But some of the sort of things that jumped out at me is that the evidence of a number of firms that did fail, and some of the consequences there, where there was an inability to account for customer money. It just kind of disappeared, and quite a large amount of customer money disappeared. So I totally understand the motivation of the regulator and hopefully the industry at large to tighten things up and get better. But as you say, Lorraine, a lot of the firms here, and we're talking hundreds and hundreds of firms in the UK that are exposed to the current regime and therefore the new changes. You know, they've got to implement even more change. Should we just try and break it down a little bit, like what some of the changes are that are coming and some practical steps that firms can take even at this point to prepare and get ready for those changes. What sort of guidance would you give to people to make them aware of what's coming?
Yeah, well, Lorraine, would you like to start with that?
Yeah, I don't mind starting. Yeah, absolutely. So I think, yeah, it's important to break this down because the FCA are not just tweaking a few rules necessarily. These changes are quite significant, like I've just suggested. And, firms that don't prepare are going to find themselves scrambling around a little bit later. But I think in terms of what firms need to be looking at in particular to try and meet the new standards. So, one of the things the FCA is looking at is tightening the requirements around designated segregated accounts. So, firms are going to have to ensure the customer funds are held separately in accounts that fully comply with those new rules. So that might mean renegotiating terms with your banking providers or even switching providers. And we know historically for payment services firms, it's been more and more difficult to get firms that, especially the big high street branches, just won't offer segregated bank accounts to many firms. But they're going to have to look at that in terms of making sure that the current provider can also meet those new standards. We're going to have to look at their revising their safeguarding statements, disclosures, just to align with the new framework. And I think, if firms haven't looked at reviewing their safeguarding account structure recently, I think now's the time. They're also going to have to look at their internal oversight and reconciliation processes. They've got to be clear, documented processes, daily reconciliations, board level oversight, etc. And, the resolution pack, which will be very new for people working in this environment, very familiar to those that are currently under the CAS rules currently, but that resolution pack means they're going to have to be prepared in a way that makes it easier for the regulators or insolvency practitioners to step in if something goes wrong in terms of how funds are segregated, where the money's held, what happens in insolvency scenario. So it's a fully documented safeguarding framework, not just a policy and some processes anymore. So I think these are the things that I think will be kind of key. I don't know if you'd add anything to that.
Yeah, so the ones I would add to that, they're codifying the requirement, and this actually builds on quite sort of one of your points quite nicely, that you have to review the diversification of your safeguarding. It's no longer going to be seen as sort of one and done. You need to consider, do I need multiple providers of safeguarding accounts, which, as Lorraine was saying, has presented quite an issue for firms in the past, that it's hard to get on board with multiple banks to provide these accounts. The other side is the reporting to the FCA. The FCA is pushing for monthly reporting of safeguarding your processes and the scale of the safeguarding you've got on at that month. I think that's going to be quite burdensome on firms. They're going to need to build a lot of record keeping and data flow processes with the banks and providers that they are working with in order to get this electronic reporting in. It will come with the advantage that the FCA is probably going to be a bit more targeted in its supervision of firms. So hopefully the firms in a good position will see less of the FCA coming in and asking them questions, but they still need to build these additional sort of APIs and data flows with the providers they're working with. And the last one that I think is quite interesting is the allocation of responsibility for the safeguarding processes to a particular individual within the firm. That has a real sort of sense of SNCR for a payment services firm. There's always been talk of the FCA extending the regime to payment and e-money firms. This is perhaps the first evidence of what that will look like in due course.
So this sounds really practical to me, and this is exactly the kind of conversation that I wanted to have. Bring this to life. Just play back a few things that I've just heard here. Is one, this is about operational change. So changing the way that your organization operates. It's not just getting documentation and policies created and signed off and everything looking on the surface very well. You've got to really think about how you manage your business, how you manage information and data, which partners you work with, including banking partners. So it's a big operational aspect here. The last point you just touched on there, James, then is accountability. This isn't just to protect the license or maintain your position as a license holder, there has to be accountability of an individual person here to make sure that this is done well and done properly. I'm sure there'd be consequences if not for that person, which also sharpens people's minds. And then the other thing that you said is that relationships in the industry will change. There aren't that many banks in the UK that can offer services to this market. And as we know, that the banks that do offer those services, as their appetites have changed over time. Luckily, there has been more competition and there are more banks that are able to offer services. But it sounds like with this change, there might be organisations that need multiple relationships rather than a single relationship. And that will require time. So time of people to evaluate options and also time of the different banks in the market to consider whether they're a good fit or not for the client. So sounds like wholesale change across the board. What are the bottlenecks that will happen, do you think, if you were to sort of think forward over the coming months? And by the way, time framing here is going to be interesting. What are some of the bottlenecks or some of the things that could go wrong if people don't get properly prepared and properly organised to manage this change that's coming?
Yeah, so from my perspective, one of the key bottlenecks will be getting or building that infrastructure within your firm to do the review of your sort of ongoing safeguarding data, allocating responsibility for monitoring what are our safeguarding requirements, what are the current safeguarding arrangements we have in place. Do we have that reconciliation flow and reconciliation audit trail that we can hand over as part of both the resolution pack and for our statutory audit in due course? Building those additional sort of compliance monitoring aspects into your firm is going to take time and going to need to sort of have quite specialised expertise around safeguarding. We see sort of in the sort of CAS equivalent, CAS specialists within compliance teams are sort of gold dust to the FCA and the FCA's views. I think the FCA will start pushing for that within payments firms, having people within the compliance function that are specialised in this area and able to handle the data that's coming through, and building that data flow, building that expertise is going to take time within the firms. In terms of timeframes more generally, I think we've got probably until the end of this year is likely to be when the interim state rules come into effect. The FCA said it's going to come back with its consultation response in the first 6 months of 2025. I'm guessing maybe end of April for that, and then they say they'll have a 6-month implementation window. So got about maybe 8-9 months to start putting this together, and then the end state rules will probably be in some point in 2026, I would guess.
Mm-hmm.
Yeah.
I think the big one for me is, and I know we've touched on it a couple of times now, is the current banking provider. You've just mentioned yourself, and you're right. There's fewer and fewer banks offering it, and some firms are actually going to banks in Europe, which they can do to offer that. But I think, setting up a safeguarding bank account isn't something that happens overnight, because the third-party banking providers themselves have their own due diligence, and the process can be quite elongated. So it's not something that, my advice to firms would, don't leave that to the last minute. Get that moving now if you feel that's going to be an issue, and if your bank can't support, looking for the alternatives. And of course the point around diversifying anyway with the banking partners, just to avoid any concentration risk. I think and I know that you touched on it, James, as well, the kind of like responsibility or accountability, and it's quite the question around SMCR for payments firms been in my mind for a couple of years, but it never seems to be going anywhere. But you're right, maybe this is the beginning of that. But I think as part of that oversight, of course, is the reconciliation process, which can be quite time consuming and can be prone to error, particularly where businesses use very manual reconciliation processes. And that, I think, with the increased scrutiny, is going to be quite impactful as well. So I think automating, particularly as we deal with, like I say, a lot of smaller businesses who don't always have the automated reconciliations in place, and making sure that the compliance teams have an escalation framework to deal with any discrepancies, and that there's someone accountable for the overall oversight of that. I think also designing the CAS resolution pack that I've mentioned before. Firms haven't operated under CAS before, so that's going to need to be designed, and that's going to probably require input from finance, compliance, legal and risk teams. So it's good to start mapping out those processes as well. And I think maybe they need to think about the capacity and expertise within the business as well, just to make sure you've got the right kind of specialists in your business if there is a gap and it needs bridging. So training.
So let's just take stock then, and for ourselves as people deep in this area in our organisations, but also the industry, we've got mandatory change coming. It's affecting the entire industry. There's hundreds of organisations and thousands of people that are impacted. There's, to James's timeline, might be a little bit longer, 10 months in which to get ready and implement this change. But let's take out the summer, that's 1 month. Let's take out the end of the year, that's another month. That leaves 8 months for hundreds of organisations to get ready. Now, hundreds of organisations haven't got 8 months, because if everyone leaves it till the last minute, that change will not happen. People won't have the support that they need, either from specialists like yourselves and your firms, other similar firms, from the banks in the market. We'd end up with a huge scramble. Like any mandatory change, people tend to leave it until as late as they possibly can, right? and think they've got all this time. So in my mind, having seen a lot of change over the last 25 years in banking and payments, better to start to get ready, organise yourselves, have your choice about who you want to work with, rather than just whoever's left at the end that happens to have some spare capacity or support to work with you, and just start to explore this now. For me, that's probably the biggest bottleneck, is inertia of people to embrace change.
I think that's right. Firms should be getting their project teams together now. They should be identifying that senior manager that we've talked about and get them as the point person on it, and start working out what do we need to do in terms of looking at our current arrangements. What do we need to build as additional tech layers on top of that to get the automated reconciliation as much as we can, or get the data flow from providers of these services, and then working out what does the back end look like. How do we get this audit built into our sort of annual processes? How do we get the reporting data sort of both flowing to the FCA, but also flowing up to management, so that senior manager individual can say that they are meeting their responsibility. Getting your project started is the biggest step, I think, at the minute.
So anyone listening to this might think, oh, we're putting this podcast together to say, hey, you've all got to do something, and we're all thinking, well, we've got something to gain from this. But we're all there to make the industry run smoothly. Yeah. And the last thing that any of us want to do is be scrambling around trying to help people. And this is forced change, so it's even worse, right? Yeah. But what's the upside? There must be some benefits that people can sort of take advantage of and position themselves for. What would you say are the upsides and the benefits of this kind of change?
Do you know what? It's really important to think about this. We tend to get sort of bogged down in the negatives and the challenges of regulatory change. But if you address it as a bit of a business enabler, then you're probably best placed. I think there are some real benefits. Look, that improved customer confidence. Customer confidence is, gone up and down over the years. And those stronger safeguarding rules mean better protection for customer funds. And in an industry, particularly where trust is everything, right? That to me can only be a good thing. I think the clear accountability of oversight, etc., is going to then create a more transparent system. It's going to reduce the risk to you as a business as a result of the chance of not misusing those customer funds. I think also the CAS or that alignment with CAS and the resolution pack is going to bring some benefits to payments e-money firms. I think it's going to bring them closer in line with those investment firms and banks, and that's going to make it easy, I think, perhaps ultimately for them to interact with the banking partners and reduce the barriers perhaps a little bit in accessing banking services, maybe, because we know a lot of banks have de-risked. And it's, listen, Operation Resilience is also a big buzzword at the moment, and I think it's going to strengthen reconciliation processes as well, particularly where it involves third parties. And I think firms are just going to have a better handle on their financial position, which ultimately brings a bit bit more competition if they invest in compliance now. So, I think it can be a good thing. Just don't leave it to the last minute and don't have a bit of a fire drill, because like you
Because
have
we're
seen
all
that
going to be
happen
very
so
busy at
much.
that point.
We are going to be very busy. Agree. Yeah, you're right.
James, what's your take on the benefits and the upside?
Yeah, I mean, I completely agree with all the points Lorraine made on that. The other sort of aspects I see around it, it brings certainty to the rules. A lot of what's been sort of going on at the minute has been done by the FCA's approach document, which I think is a very good document, but it's guidance and it's not the be all and end all from the FCA's enforcement perspective. So it gives firms the certainty over the rules. It also brings consistency between firms. There's no longer going to be firms applying different standards to what is ultimately seen to scale or type of business, and ensures that firms are subject to sort of equal regulatory burdens. And then there's the point that sort of made a bit earlier that because the FCA is going to be getting a lot more data, it's going to be sort of comfortable firms are operating on the same base layer of rules. It allows the FCA to target those firms that are the greatest risk, and those firms that are compliant, have a strong process in place already, can show the FCA that they're meeting the requirements already, will just be allowed to, I think, just carry on as normal without having to have FCA sort of investigations or queries on a regular basis. It will therefore sort of lift the day-to-day burden, I would hope, for firms, and basically help clean up the bad actors within the industry.
So last question, we're in the last 30 seconds here. To me, this alignment then could be a great opportunity from a people and development perspective. Do you think alignment of these two regimes could make it easier to access a wider talent pool of specialists to help firms, rather than this sort of two divergent streams? Is that a thing that actually would be beneficial?
I think, yes, exactly. As sort of we've talked about for a bit earlier, payments and the regulation of payments is a relatively young financial service industry, and the sort of talent pool has been somewhat limited in terms of the pure compliance aspect, I would say. And therefore being able to sort of say that these two regimes, like the FCA has been saying, are CAS alike or parallel to CAS, will mean that there's greater ability to cross over, both in terms of talent pool, but also sort of diversity of approach and diversity of thought around these points, and bring a bit of innovation across from the investment world into the payments world, because the two regimes are now going to be a bit more aligned.
I would agree with all of what's been said there. I mean, it's very true that, in the payment services world, it is a little bit more immature with regards to other sectors. So I think bringing both those regimes together should definitely help in that regard. And just echo what's been said there.
Cool. Thanks very much for your time. Really appreciate the chat. Hopefully we'll have another opportunity to chat in the future. Hope it's been useful for everybody listening, and have a lovely afternoon.
Thank you.
Thank you.
Thanks, everyone. Thank you.
Cheers.
Take care.
Bye-bye.